everyone. So our next session is on the power of Proptech. And I'm joined today with Mr. Tanvir Shah, who's the director of the Partnerships Advisory, and by Jatin Ondhia, who's the founder and CEO of Shojin. I'll give you guys a minute to introduce yourselves.
Hi, I'm Jatin, CEO of Shojin Property Partners. We're based in London. We are an FCA-regulated fractional investment marketplace, and we specialize in providing investment into the real estate development sector. So through our platform, investors are able to invest into mid-market development projects like apartments, houses, on a fractional basis, so as little as £5,000. And today we have investors in about 60 countries.
Good afternoon, everyone. Thank you for joining. I'm Tanvir Shah. I have 3 roles. I'm the Managing Director of the Partnerships Advisory, where we advise banks, insurance companies, fintechs, insurtechs across GCC and East Africa. Second is I am a fund manager in India, where we have a hospitality real estate fund building hotels across Western India. And third is I am an instructor at Harvard University. I'm a Harvard alum and instructor teaching real estate finance in Boston and in their programs globally.
So real estate finance, if we convert that into another, into other words, that becomes the topic for today, which is Proptech and the Fintech transformation. So what I want you to start with first is explain Proptech and the Fintech transformation that you've been a part of.
Sure. So I look at the technology of today needs to be used in the businesses of today. So any technology that is available today should be used in the property world as well. Property world, I look at it as 4 processes. First is the search and discovery. So you do the research, what kind of land should I buy, where should I build, what should I invest in. Second is you have to finance that opportunity, whatever you found. The third is then you need to construct.
Yeah.
And the fourth is once you've constructed and potentially sold is to maintain it. So sales and maintenance comes as the 4th bucket. Most retail investors only look at the last 4th, which is I need to buy a ready property, rent it out, and just maintain it so it's livable by the tenant, and hopefully it makes me some money. A lot of Proptech is before you come to that 4th stage. It's in that search and discovery. So you have to, let's say, Property Finder or Bayut or Property Monitor, indices. The Dubai Land Department is also looking at technology-driven sort of data availability for the market. Developers use that to make real-time decisions on what to construct. Then when they want to construct, they need to use today's technology to be able to construct quickly, cheaply, and more innovatively. So go higher, go deeper, go into the sea.
You're still looking at a B2B and a B2C perspective on this, right?
I'm just looking at real estate.
Okay.
I'm an outside onlooker saying, what is the world of real estate? How did this building get built? Who financed it? Who constructed it? How did they construct it? What technologies were used in financing it, in building it, in selling it? Okay. Why was it built here and not across the street? What decision did they take saying, is this a Dubai Marina facing plot? And a Dubai Marina facing plot fetches 50% more than Sheikh Zayed facing plot. So all that data comes to them because of technologies of the day. So I'm very interested in the whole process rather than just the end process which the end consumer sees, because we're industry practitioners. As an industry practitioners, I need to see, can I insure a building cheaper, quicker, more comprehensively? If technology allows me to talk to an insurer in Japan who's willing to give me a better rate. So every technology that enables real estate to be built quicker, cheaper, and better is of interest to Proptech.
Okay.
That's my take on it.
And the fintech side?
So then comes the financing, right? So I said the second vertical is financing that sort of idea that you have, that I want to build a 40-story building on this plot of land. The minute you say that, the next minute, you need $40 million.
Right.
Now, financing that, there's 2 elements. One is developer financing on the B2B side. and then the end consumer financing on the B2C side. On that, there are a lot of sort of startups, both in India and the Middle East, which are now very strongly connected, making inroads in how a consumer can tap finance nearly globally. So sitting here, I can tap finance for a house in India that needs to be built next year. Right. Someone is willing to finance that because of the AR, VR technologies that are available that make it realistic for me to take a bet, saying I'm willing to put 20% down payment on an asset in rural India, which will get financed by someone in Mumbai because of the technologies that are available.
Jatin, this is where your startup comes in, right?
Yeah, absolutely. So in that particular vertical, we go deep. So rather than going across, we specialize and focus on that finance part. Now, if you think about it, there are two major social problems globally. The first is we are not building enough homes. This is an acute problem in places like the UK, across Europe, and so on. We're not building enough homes because a lot of the developers can't get the finance they need. The large home builders build mega schemes, but they're not building enough, and a lot of the mid-sized schemes don't get built because developers haven't got funding. So that takes us to the second big social problem. Wealth is concentrated in the hands of the few at the top. But just below that, you've got a lot of people who would love to invest into real estate and real estate finance. In an ideal world, every person on the planet should be able to invest into this space. But they can't. They don't have access. They don't know how to assess a project. So the very wealthy get access to this development finance space where they're making very good returns of 20 to 30% per annum, but everybody else can't get it. So what we realized is, well, if the developers need funding, but they're not getting it from the major private equity guys, why? Because it's too small for them. They need to focus on deploying a lot more capital. Then maybe the way to do it is to open this up to the people, to the crowd. And that's where we found that actually there was a huge demand for this. Because as a regular person, you can only access mainstream investment products like equities, bonds, and so on. But with this model, using technology, and the technology is a crucial part here, everyone can invest 5, 10, 20, 50,000 pounds, whatever they want to.
If the returns are what you're saying, what, 20 to 30%?
20 to 30.
Then why wouldn't the big boys want to be a part of this?
So very simply put, if you take a £10 million project, you would get £6 million of senior funding. That's easy to get. You can go to the banks. The developer normally has to put in £4 million. Now, the developer's only got £1 million. Now, it's a great project. Everything checks out. All the due diligence checks out, but the developer doesn't have enough money. So he needs £3 million. Now, if you go to a private equity firm, they're raising a lot of money, and they've got to deploy a lot of money. They're not going to mess around with a £3 million ticket when they want to deploy chunks of 20, 30, 50 million. So it's easier to raise 20 million than it is to raise 3 million. And therein lies the opportunity. Because there is no ready market for funding, if you want a mortgage, you can go to a dozen banks right now. But if you need junior finance for real estate development, there's no one to go to. Now, because of the lack of funding, the land is priced lower because there's less competition, right? Let me give you an example. If you're doing a very small project, lots of amateur developers will be bidding on the same site. They'll push the price up. But when you're in this middle market, 10 to 60 million pounds, there's less competition. So your price is lower, which means that your profit margin is higher. Hence, that developer will come and talk to us, we'll provide the funding, we will charge anywhere between 20 and 35% per annum. They're happy to pay that because even after paying us, they're making a fantastic profit and they're getting a huge return on their capital and they're stepping up in terms of their business evolution. And then we can offer that to the investors. We keep about 25% and give the rest to investors. So now investors can get, say, 15 to 25% per annum. And it's not even a highly risky product. Is it more risk than leaving your money in the bank? Of course. But it's not that much more risk. It's an inefficient market. And if there's one thing that we've learned over as long as investing has existed, it's if you have an inefficient market, you can generate outsized returns relative to your level of risk.
How do you see this translated into the UAE? Because you're talking about the UK market, right? Compared to that?
So absolutely necessary. There are some DIFC-based, what is called the CAT 3C fund managers who do real estate credit, looking at it. At the moment, there are active players on the fractional ownership of real estate at the retail level, but sort of fractional investments of real estate credit for developer financing is the next wave that has to come.
Right.
And I believe that will have a much higher impact on the economy, on the real estate world, than the sort of what we call the end takeout loans. So, and I've been a mortgage finance guy, right? I built large mortgage books in the region. And while the mortgage looks more voluminous and more active, if you can fund 1/10 or 100 that many developers, the impact will be much more.
Right.
So developer finance in the UAE is crucial now that the population is increasing exponentially, and this is for someone who's lived here 50 years. I have not seen this kind of exponential growth for Dubai, what we've seen post-COVID, anytime in the last 20, 30 years. Everyone wants a home here. Everyone wants to live here. Yeah. Developers need to build here. And developer financing is really thinly stretched at the moment.
And we're facing the same problem as the UK, which is
yes.
less houses,
so same
more
problem,
demand.
Same inefficiencies, because again, the big boys want to finance the large developers.
Right.
So as he rightly said, it's easier in Dubai to get 100 million dirham financed than a million dirham, 2 million dirham finance. But if you see that there are a lot of private developers that have come into the market, especially in the freehold space, they're not government backed. They're entrepreneurial developers saying, hey, I'm willing to put in 50 million dirhams, but I want to build a 500 million dirham project. Right. I need 20, 30 million dirhams every quarter, every year to build a new building, build a block C, block D, block E. And that developer financing could come very well through fractional ownership into that fund vehicle, essentially, or the pooled vehicle, which then deploys financing for developers.
But this community model is, you know, like if you look historically, it's relatively new, right? Like if you're looking at the subcontinent, if you're looking at Pakistan or India,
no, not at all.
I would personally get land and I would get the finance and I would build my house myself. I wouldn't be going into...
No, so the market has always existed.
Yeah.
Partnerships have existed for millennia. So this is a partnership. It's just enabling partnerships between unknown parties. You would usually do a partnership with your relative.
Right.
You know, 3 brothers coming together and buying a farmland. It's as old as, as humankind. It's friends coming together and buying a plot of land and developing. It's just now you can partner with someone sitting in Muscat who you've never met.
Right.
And both of you could put in, let's say, $50,000. 50 other people who you never met could come in and put in $50,000 each. How do you ensure that that contract is valid? See, even when you talk about property rights, it's all piece of paper. The title deed is a piece of paper.
Yeah, and this is where I'm going to jump into the blockchain story.
So that's, I'll leave it for you to talk about that.
Can I just also add to that, right? So this is going to be a little bit controversial, but the reality is, I think John Lennon said it best, imagine no possessions, right? We don't need to own the property. If you think about it, when people invest in property, they are investing, it's an investment. It's that word, investment. You make an investment to generate value, to have more later than you have today. The problem with, and sorry, I know this goes against the mortgage business, but the problem in a lot of cases is, people buy property, they get leverage, they, take a mortgage and so on, but that's not their job, that's not their core expertise. And so they get, sometimes they get good returns if the market does well, that's just riding a wave. But in the future, the better way to do this is for the people to own the property. Now, I'm not saying we all become communists. I'm saying that the people have direct ability to directly invest. So if you take a building of 100 apartments, instead of getting a mortgage for 100 different individuals, you finance the whole building and you sell people a share of that investment.
But is my name on the title deed? Do I actually own the property?
So you own the property in the same way that your name is on the title when you buy shares, right? Because a regulated company like Shojin, for example, we have a security trustee, and the security is held for the benefit of trustees. Shojin could disappear, but your security will still be there. So the same risk applies, right? You own a property, one apartment in a building. This way, you're owning a share in that same building, but the benefit is you don't have to worry about the financing, the maintenance, if it's rented out, all sorts of issues. You don't have to worry about it. And because you're not buying one apartment, but we're buying the whole building, you're getting economies of scale. You're getting the benefit of the aggregate lower price, which means your returns are going to be stronger. So if someone was going to put, let's say, $500,000 into one apartment, or they put $500,000 into this fractional ownership model, the returns would be better through fractional, the hassle would be less, and the security is identical because you still own that asset.
Yeah, but this is, this would be sort of like the dollar cost average, right? Like if I diversify my portfolio, I sit somewhere in the middle. So I'm not going to make exponential returns, I'm not going to make lower returns, I make somewhere in the middle.
Not necessarily, because remember, when you're buying one apartment, that one apartment and that whole building are going to move up and down in unison in terms of value, right? Your apartment and the one next door are going to move in unison. So you're not losing anything. You're actually buying at a cheaper price. So you're getting the benefit of that. Your returns should be higher. But also, and this is another interesting one, people like the idea of stock picking, right? It's a fun game. Most people don't really make any money through stock picking. If you look at your cash-on-cash return, it's not that great. Why? Because that's not your day-to-day job. The idea with fractional investment is to make it passive and enable you to get on with your life. A good example is, if your money is invested in a number of these schemes and it's diversified, and you're throwing off returns of 15 to 25% per annum, that means your money is probably working harder than you need to, which leaves you as an individual free to do exactly what you want to do. Too many people in the world are doing jobs they don't really enjoy, or they're not adding value to society. This way, you don't even have to work. If you want to sit on a beach, you can, but the reality is most people won't. They'll do something with their time. They'll give back to society, or they'll work in a job that's more fulfilling for them.
So coming back to, we've spoken about fractionalizing it. Now, tokenizing it is where we come back to your statement on it's still a piece of paper. Like putting it on a smart contract, putting it on a chain, that just becomes, an irrefutable piece of evidence. Now, I've seen other countries that have gone through the process of tokenization, but the UAE, where we're, miles ahead of everyone else in other industries, in this one, we haven't moved, but not since we sat on the panel last year and spoke about this.
So I do have a government role as well, which I should have mentioned. I'm on the investment committee of the Mohammed bin Rashid Innovation Fund. So I have my limits on how much I can speak when representing the government. But we do know that the government is keen to introduce blockchain in multiple areas of real estate, especially the title deed. How far that'll go, whether that'll go ahead the way we would desire, or whether how the crypto Oasis would desire, is something that needs to be discussed. What is important to understand is all rights are rights bestowed by society on an individual. and registered by society or society's instruments. So when you go and register your land asset with a national or government body in any country, it's as long as the government is there and that society recognizes that piece of paper. You had communism come in and all those pieces of paper.
Decentralization is the problem?
No, it's just the point is that everything is still backed by me recognizing your rights, right? It's society recognizing that plot 7 is owned by Faisal. As long as society is willing to recognize and acknowledge that Faisal is providing some evidence that plot 7 is his, and we all, through a technology, through a piece of paper, through a central registry, through a government registry, private registry, centralized, decentralized, we all need to recognize plot 7 is Faisal's. So to his point, as long as there is a government regulated entity that says plot 7 is owned by these 30 people, or these 300 people, or these 3,000 people, that government entity could be the Dubai Land Department, it could be the Dubai Financial Services Regulatory Authority. Right. So just like in shares, when you say I own 10% of Apple, or a Mark Zuckerberg goes and says I own 5% of Facebook, someone has to acknowledge that, right? Someone has to agree and accept that. Right. That is not a land department, that's a share registry. Right. So you trust the share registry for all your other assets, all your liquid assets, all your share assets. Why can't you trust them for your real estate assets?
Well, the problem comes in, right? Like I can transfer it to your wallet right now without having anyone else recognize it. It's only you that needs to recognize that you've received it from me.
So I think at least in land rights, as humans stand today, I think you will need a government entity. Okay. I don't think that will be fully decentralized in the foreseeable 5 to 10 years.
But the government sits on the top of the contract, right?
Yeah,
like
that's fine.
How are you doing SPVs?
Right. So the simplest example is when you buy a property, you register it at land registry, right? So you have your name on the title. Now, if you buy it, your name's on the title. But if we're fractionalizing it, we create an SPV just for that property. That SPV then is listed on land registry. The security is taken by that SPV, and then it's held by an FCA-regulated security trustee. So what that means is, even if we disappear, your connection with that asset is still there. So let's say there are 100 investors in that property, you're all represented through the security trustee. And again, being a regulated entity, we have to park cash aside. So even if we go down, there's money there for somebody to step into that security trustee and administer everyone's security. So it is identical, exactly as you said. It's like a share registry, right? And if your broker goes down, there's still a register somewhere about your ownership. Right. It's exactly along the same lines.
So in Dubai, if I give an example, the DFSA already has this regime. It's just used by the super HNIs, the high net worth individuals. You need at least $500,000 of liquid investable surplus to be considered a professional investor in the DFSA regime. But if you look at, so in DFSA there are 4 categories of companies. So if you look at the category 4 companies of arrangers and advisors, that's essentially what most fractional ownership entities do. So they are an arranger and advisor to you, advising on the SPV. But the SPV is an independent entity. So if 10 people put in $10 million each, each of them owns 10% of that SPV. It's a partnership vehicle that is registered with the DFSA. It is arranged and advised by a DIFC entity. That arranger and advisor can change. That arranger and advisor could be a technology. It could be the blockchain that enables the registration of that unit, as long as the DFSA recognizes it and society recognizes it. So a centralized government-backed private blockchain where this asset is registered would add a lot of confidence for global investors to come in, as long as it is supported by either the land registry of the country or the share registry or the securities registry of the country. And in this case, we have those elements in play already.
So the question is how now, how they put this together instead of when? essentially, because this is like there's organizations popping up on almost a daily basis that their primary objective is to be able to fractionalize or tokenize real estate, because that I think is one of the things that we've been missing over here, because to get on that property ladder, you know, like you're making it easy in the UK, you have companies like Stake over here that are making it easy for people here, but you need to have 20% of, you know, the value of the house, even if you want to buy the house for yourself.
No, so he's fractionalizing lending.
Yeah.
He's a lender whose balance sheet is propped up by 5,000 people. So he's a balance sheet lender, which is very different from tokenizing asset ownership. What you're talking about is existing assets.
He can still buy that out, right?
We can. So primarily, we are exactly that. We're a lender. We're using technology to fractionalize it. So rather than a bank which takes deposit, we fractionalize across the people. But when we buy an asset, right? So let's say we buy a student accommodation block. Now, we could of course buy it all for cash, but there's just no point, right? I mean, even in a higher interest rate environment, leverage still makes sense. So we might have to put in 30% and then take bank funding, right? Just like if you buy an apartment to rent out, you'll probably use bank funding. So what we do is we fractionalize that 30%, but we still go to the bank for the 70. So you can still take leverage.
Okay. So since we have another 10 minutes to go, I'd like to focus on the sustainability of how Proptech and Fintech, you know, like combine, how you can bring in sustainability, because we have COP28 starting in you know, a month and some time, and it is one of the primary agenda items for the government over here, sustainability. So if you can share some examples, and what can we expect from, you know, like Proptech and Fintech to help with sustainability?
So again, from the financing of projects perspective, we advise one of the largest banks in the UAE on a oil deal in Bahrain recently. And this is oil refinery, okay, building a new facility. And this is the first time that we put, or that bank put, sustainable metrics alongside finance metrics on the development of a real estate project, infrastructure.
Yeah.
And this is where I believe within 2 years, it'll become the norm across at least all oil and gas projects across GCC.
What would those sustainability metrics look like?
So there were about 40 metrics that we put in.
Okay.
All the way from diversity and inclusion, how many women, the gender diversity angle, the concentration of a particular nationality. We had climate metrics that were quite, I think about 20 of those were climate metrics around carbon emissions, reduction of wastage, reduction of sort of oil spill and sort of our downstream wastage. Recycling was a big part of it. We had about, I think about 3 or 4 of those were recycling metrics that need to be measured every month.
Okay.
And as a banker, as a pure banker, it was unique. It was something that even the CFO at the oil and gas company had never done before. The lenders hadn't done before. But thankfully, we brought in a non-banker sustainability expert to guide us on that element. Right. So this is where the world is changing, right? Most financing of infrastructure, real estate, has always been numbers driven only. But now we're bringing in technologies to measure carbon dioxide that didn't exist. That's being funded by the bank, right? Which was unthinkable 3 or 4 years back. Why would the bank take that cost? Why would they take that initiative? And then to monitor it on a monthly basis. A lot of it is by sensors that have been placed or are going to be placed in the facility when they're built. And that's all technology driven. So sitting in Dubai, they'll be able to monitor the climate impact on a monthly basis, actually on a real-time basis, of that facility across the different sort of locations where the sensors have been put.
So, just on that, is this voluntary or is it forced? or is it regulatory?
From the bank side, it was voluntary.
Okay.
For the borrower, it was forced. It's you're not getting this financing if you don't agree to these terms. But it was incentivized with a lower rate than what any other bank was giving them. So they showed the best offer that they had. This bank gave a lower offer contingent on sustainability metrics being met.
All right. Jatin?
Yeah, I mean, so I'm not sure if you're aware, but across Europe, there is a new level of reporting required of all financial institutions, starting with the biggest, and then soon it will be everyone. And that captures a lot of what you've said. So in fact, that's gonna be the norm soon, where a bank won't be able to work with you unless you're reporting these sustainability measures. And then when they're reporting these, they've got to manage the exposure, right? So this is, it's happening, right? And it should happen. I think it's brilliant. I think the biggest challenge is how it impacts SME developers in particular. When you have a big pipeline project, it's worth billions. You can afford to, get a sustainability consultant and so on. So how do you actually get that to work through the rest of the system? And this is actually where Proptech comes in, right? Because the biggest problem developers have is even if you say to them, look, I'll give you a cheaper rate if you make your development sustainable, they'll say, yeah, all right, great, but I have no idea how to even begin to make it sustainable. It's not their expertise. They don't know who their suppliers are. They don't know what the relative merits are. So one thing that we've discussed, and again, I'm not sure if you're aware of this, but the British Business Bank is a shareholder in our business. Okay. And the UK has very high sustainability goals. So even with them, and in fact with the Mayor's International Business Programme, who are also here, sustainability has been a big focal point. And so we're trying to figure out a way that we can bring this and make it easier for mid-sized developers by using technology. So it could be things like supply line management. 35% of global emissions comes from the built environment. Construction is a massive contributor. Concrete is huge. So how do you reduce that? Well, I wouldn't even know where to start. But there are some very smart people in the world doing some very smart things on this. And if we can connect that up to with the developers, then the developer then has no excuse not to build sustainably, and they'll get a better rate. So it's about incentivizing the developers, but also giving them the tools they need to deliver, and that's where Proptech comes in.
So just on the sustainability part of Proptech, because you spoke about the finance side, right? But I know that you're involved with a lot of the property side as well. So how have you seen that, impacting sustainability? Because again, with the oil refinery, there has to be an element of sustainability in the construction, in the development, and then finally in the finance.
No, so even in normal housing, so we're building a real estate income fund in DIFC, and all the assets that we will be buying will be income producing assets with at least 5 years rent roll. So 5-year plus old buildings that we're buying, and all the investments have to be ESG compliant. This is a requirement from all the investors that we've spoken to. Okay. So it's $100 million equity book and $100 million debt, 1:1. So we're going to be buying about $200 million of assets across Dubai. And all the $100 million that has been committed is committed based on ESG compliance. So a lot of the assets that we'll be buying, we may have to repurpose, especially the MEP, the electrical and plumbing that was put in old buildings had no insights into wastewater management, grey water management, segregation of waste, recycling. Those elements just don't exist. If you go to a building in Discovery City, Discovery Gardens, International City, even JVC, which is now almost a decade old, it doesn't exist. You just throw it all in one chute, and hopefully it gets to the landfill somehow.
Even you still have new developments that are coming in that don't have a consideration for this.
Everyone's got a problem. Yeah. and post COP28, I believe within the next year or two, it will start becoming mandated by government, semi-government entities, but also demanded by investors, demanded by the lender, demanded by the tenant or the occupant or the buyer. So all those pressures are coming in from all sides, saying, is this a green building? And that's not a question that developers used to ask 5 or 8 years back. But over the last 3 to 5 years, you see developers putting that into their vocabulary.
No, but you've got the Pearl rating, you've got Istidama, you've got leads.
Those have existed, but not everyone has used them.
No.
So that's the sort of positive part, that the ecosystem already exists. It's just that the developer now has to opt in and say that it is far more conducive to use all the technologies available to build a better building, and a more sustainable building, a more greener building. To verify that, they'll go to the existing ratings.
Got it.
Today, they're not going to the existing ratings. Not everyone's going, especially when you go outside Dubai. So we're looking at UAE, we're looking at GCC, we're looking at MENA, MIA, and now Dubai is now a global city. So a lot of people have their eyes here. A lot of the investors that are coming in from Canada, from Singapore, are opening the conversation with ESG. ESG is a minimum requirement to seek their investments. So that's how the world is changing, and technology is enabling that compliance.
Awesome. So I'd like to open this up for questions from the audience. Anyone?
Hello, my name is Tariq. So my question is for Jatin. How do you manage the risk of the projects you are picking? Because, one of the problems over here, for example, in UAE, is, of course, the big developer have huge financing. Normal Emiratis, when they want to build their houses, they have easy financing. But then, for example, the new projects, which is coming by maybe a foreign hotel or a foreign developer, banks are not giving for this because they are not financing greenfield projects, mostly. So for you, how would I, as an investor, how would I know that you picked the right project and that it won't blow or just,
So that's a really good question. Risk is at the heart of everything. You can't have investment without the word risk, and it's all about how much risk am I taking. Now, when a developer comes direct to you as an investor, the single biggest problem is there's no way for you to, unless you have a real expertise in construction and all the rest, everything about real estate, it's very hard for you to assess that project. So the first thing to note is, by us being in the middle, we're shielding investors from that. We are doing the donkey work. We're doing the deep dive due diligence, because we don't make money unless investors make money, because we take a spread. So it's in our interest as much as everyone else's that the project goes well. Now, the risk process itself, it's a multi-layered risk process that we do internally. There are over 200 items of risk that we go through. And very simply put, I could go on for hours, but very simply put, we identify every single risk with the developer. We look at the developer, the contractor, the balance sheet, the market, the micro location, the school, the bus stop, the tube, you name it. But we even go and look at things like how do you access the site? How easy is it to get trucks in and out? Right of light, ground conditions, you name it. And what we're doing is firstly identifying risks. There's no such thing as a project without risk, right? So we identify all the risks, because developers can be very over-optimistic. We like to be very pessimistic. Everything that can go wrong, we assume will go wrong. So we identify the risks, and let's say that there are 7 proper risks identified. We then look at how each risk can be mitigated before we go in. So for certain things like ground conditions, you can get insurance, right of light, access. If the site is hard to access, it doesn't mean it's a bad development, but it means we have to allow more on the build costs. The construction needs to be fixed price contract with a reputable developer who has a strong balance sheet so that we know they're not going to run out of money. Once we've mitigated all of the risks, the only projects we tend to fund are the ones where the remaining risk is the one you can't mitigate, and that's market risk. But every project we look at, because there's no market for what we're doing, as in there's no competition, so we're not desperate. We're not like a bank, like we don't have to lend money. If we don't see a good project, we do nothing. But we see all the projects, and then we cherry pick the best projects, which have the lowest risk for the best return. And because of the way we do that, each project has a big, what I call, and I've stolen this from Warren Buffett, the margin of safety, right? What if something goes wrong? What if the market does crash tomorrow? How much are we exposed? How much can we absorb before we take a hit? And so all of these things play into it. Most projects have between 20 and 30% buffer, but then we also take additional security, cross-collateral. All we're doing, I think of our job as risk management, right? That's what it is. If we manage the risk, the returns will take care of themselves.
Thank you. I think I have time for one more question. No. All right. Well, I would like to thank Tanvir and Jatin for your time and for your insights. And thank you for sharing them with us.
Thank you. Thank you.